The Gapping Doji is a unique pattern observed in the world of trading, characterized by its small body and the gap that separates it from the previous candle on the chart. This gap signifies a sudden shift in market sentiment, as it deviates markedly from the previous trading session's price range, often hinting at an impending reversal in the current trend. When traders encounter a gapping doji, it's considered a prompt to pay closer attention. The small body of the doji, which appears as a thin line, reflects a period of indecision where the forces of supply and demand are almost in balance. The gap, however, suggests that a strong movement has begun, causing traders to reconsider their positions. If this pattern emerges after a prolonged trend, it could indicate that the trend is losing momentum and might soon reverse. In the conclusion, embracing the wisdom of the gapping doji involves understanding its significance as an indicator of potential market turns. Traders might see this as an opportunity to adjust their strategies, whether by securing profits from current positions before a possible reversal or preparing to enter the market in anticipation of a new trend's emergence. By carefully analyzing this pattern, traders integrate a useful tool into their analytical arsenal, improving their ability to make informed decisions in the dynamic environment of financial markets. In summary, the gapping doji serves as a crucial signal for traders, suggesting moments of indecision that could precede significant changes in the market direction. Recognizing and acting upon these signals can enhance trading strategies, providing an edge in navigating the complexities of market trends. The kicking bullish pattern is an important concept in the world of trading and technical analysis, indicating a strong bullish reversal. It is distinguished by its unique structure consisting of a gap between two candles on a chart. Picture this. On the first day, the market closes lower, often indicated by a black or red candle. This is followed by a gap where the market does not overlap the previous day's price range, leading into the next day where the market closes significantly higher, represented by a white or green candle. This gap is crucial as it underscores the shift in sentiment from bearish to decidedly bullish, suggesting a potential strong upward trend. The power of the kicking bullish pattern lies in its rarity and the strong signal it sends. It indicates a sudden and robust change in investor sentiment, where the forces of demand quickly overcome those of supply, driving prices up. For traders and investors, recognizing this pattern can be a signal to consider long positions or exit short positions, expecting the upward momentum to continue. However, it's also essential to consider the pattern within the broader market context and combine it with further analysis to make informed decisions. Identifying the kicking bullish pattern in trading involves observing a specific formation on the stock chart that typically signals a strong reversal in the market trend from bearish to bullish. This pattern is unique and can be recognized by the presence of two key candlesticks. First, you should look for a candlestick that opens and closes lower, often a strong bearish indicator, creating a gap down from the previous trading session's close. This is followed by a second candlestick that opens at or above the previous candle's low, but then significantly gaps up, closing higher than it opened. The distinguishing feature of this pattern is the gap between the two candlesticks, with the first being bearish and the second being strongly bullish, suggesting a swift change in investor sentiment from negative to positive. To spot this pattern, focus on the two contrasting candlesticks outlined. The initial candlestick indicates that sellers were in control, driving the price lower. However, the following day opens with a gap up, indicating a sudden shift where buyers take control, driving the price significantly higher throughout the session. This contrasts sharply with the prior day's sentiment and suggests a potential reversal of the downtrend. The kicking bullish pattern is considered significant because it reflects a sudden and strong shift in market dynamics. When identifying this pattern, it is crucial to pay attention to the size of the gaps and the volume supporting the bullish candlestick. An increase in trading volume during the formation of the bullish candlestick can further validate the strength of the reversal. This pattern is one of the more straightforward signals in technical analysis, making it accessible for traders at various levels of experience to understand and act upon. However, like all trading signals, it should be considered alongside other indicators and within the broader market context to make informed trading decisions. The kicking bullish pattern is a prominent indicator in stock markets that signals a strong bullish reversal. This pattern is characterized by a significant gap between two candlesticks. The first candlestick is typically bearish, indicating a downward price movement where the open and close prices are in a declining sequence. The following candlestick is bullish, meaning it reflects an upward price movement, with a noticeable gap between the two candlesticks where no trading has taken place. Deciphering market sentiment involves understanding the emotions or the attitudes of market participants towards market conditions. The appearance of a kicking bullish pattern can be a crucial signal for analysts and investors. It suggests a sudden and strong shift in sentiment from bearish to bullish. This pattern implies that investors are quickly changing their positions, leading to a potential uptrend in the stock's price. It is considered a strong signal as it indicates a sharp turnaround in market sentiment, insinuating that buyers are now dominating the market after a period of uncertainty or downward trend. Understanding this pattern and its implication in the context of deciphering market sentiment highlights the market's unpredictable nature and helps investors make more informed decisions. Recognizing such patterns can be a valuable tool in anticipating market movements, allowing for strategic positioning to capitalize on emerging opportunities. The term kicking bullish refers to a significant bullish reversal pattern that is often indicative of a shift in market sentiment from bearish to bullish. This pattern is characterized by a gap in the trading price, which signals a strong potential for upward movement in the market. A bullish reversal pattern like this suggests that after a period of downward price movement, buyers have regained control and are pushing prices higher. In the context of a signal of change, the appearance of a kicking bullish pattern is particularly noteworthy because it represents a clear and abrupt shift in momentum. Typically, this pattern is seen as a reliable indicator that the trend has changed direction. From an investor or trader's perspective, recognizing such patterns can be crucial for making informed decisions about entering or exiting positions in anticipation of future price movements. Understanding the kicking bullish pattern involves looking for a significant gap between two trading sessions, where the second session opens higher than the first session's high and continues to close substantially higher. This gap, apart from being a visually striking feature on price charts, is the hallmark that distinguishes the kicking bullish pattern from other bullish signals. In essence, the kicking bullish pattern is a beacon for change, indicating a strong bullish momentum that can often lead to sustained upward trends. It serves as an essential tool in the arsenal of those analyzing market trends, providing a clear signal that the market sentiment may have shifted from pessimism to optimism. The kicking bullish pattern signifies a strong bullish reversal in the market, distinctly marked by a gap in trading. It implies that after a period of downward trends, investors might be witnessing the dawn of a rising market era. Let us delve deeper into the pillars of confirmation that solidify the significance of this pattern. 1. Volume plays a crucial role. An increase in trading volume on the day the pattern forms provides additional validation, indicating heightened investor interest and participation. This surge in activity can often be the fuel needed to propel the market upwards. 2. Preceding market trends are essential to consider. For a kicking bullish pattern to mark a reliable reversal, it typically follows a downward or bearish trend. This foundation sets the stage for a dramatic turnaround, emphasizing the reversal's strength. 3. The absence of additional patterns or indicators suggesting continuity of the prior bearish trend acts as another pillar. In simpler terms, if there are no other signs indicating that the market will continue to fall, the kicking bullish pattern stands out as a beacon of potential upward movement. Each of these pillars serves as a checkpoint, confirming the kicking bullish pattern's reliability as an indicator of a market shift from bearish to bullish. By understanding these underpinnings, investors can make more informed decisions, recognizing opportunities for entry or adjustment in their investment strategies amidst the volatile dance of the market. The kicking bullish pattern is recognized as a strong bullish reversal signal within the realm of stock market analysis. It is typically identified by a notable gap in the price movements of a stock, which signifies a potential shift from a downward trend to an upward trend. To understand the reliability of this signal, it is essential to consider the context in which it appears. The strength of the kicking bullish pattern as a reversal signal often depends on the prevailing market conditions and the volume of trading that accompanies the price gap. Generally, a higher trading volume that coincides with the gap increases the reliability of the pattern. This is because large trading volumes signal strong investor interest and commitment to the new direction of the price movement. Additionally, the pattern's reliability is further bolstered when it appears after a prolonged downtrend. This suggests that the market sentiment is shifting from bearish to bullish, making a reversal more likely. Moreover, investors and analysts often look for confirmation of the pattern in subsequent trading sessions. A continued upward price movement following the appearance of the kicking bullish pattern can provide further evidence of a robust bullish reversal. It is also important for investors to consider other technical and fundamental factors that may affect the stock's price, as relying solely on one indicator can be risky. In summary, while the kicking bullish pattern is a powerful indicator of a potential bullish reversal, its reliability is enhanced by high trading volumes, its occurrence after a downtrend, and confirmation from subsequent price movements. It serves as a valuable tool in the arsenal of investors who use technical analysis to guide their investment decisions. The kicking bullish is a significant pattern within the realm of technical analysis that signals a strong bullish reversal. It is characterized by a gap in trading prices that marks a sudden shift from bearish to bullish sentiment among investors. This pattern stands out due to its clear visual cue, where the opening price of the bullish period leaps above the closing price of the prior bearish period, leaving no overlap and hence creating a gap. Synergy with technical analysis is paramount when interpreting the kicking bullish pattern. Technical analysis offers tools and methodologies to analyze market psychology through price movements and trading volumes. It provides a framework for understanding how such patterns emerge and what they signify about future market behavior. The kicking bullish pattern, with its stark representation of a reversal from downtrend to uptrend, is analyzed through this lens to forecast potential price increases. The rationale behind this pattern's importance in technical analysis lies in its rare occurrence and robust signal. The sudden and decisive change it represents is often seen as an indication that the downward pressure has been overwhelmingly countered by buying interest, suggesting a strong upcoming upward movement in the asset's price. Investors and analysts pay close attention to such patterns as they plan their investment strategies, looking for confirmation through other technical indicators and market analysis to make informed decisions. In summary, the kicking bullish pattern is a critical component of technical analysis that signals a potent reversal in market sentiment. Its detection and interpretation require an understanding of market dynamics and psychology, which technical analysis provides, enabling investors to navigate the complexities of market trends and make strategic investment choices. Kicking bullish is recognized as a strong bullish reversal pattern, which is particularly noted for its occurrence through a gap in the chart. This scenario unfolds in a market environment that initially appears to be dominated by bearish sentiment. The pattern is marked by a notable space that separates two candlesticks. It indicates that the market sentiment is shifting swiftly from bearish to bullish, suggesting a potential upward trend in the prices. This pattern is comprised of two key components. The first is a black or red candlestick that appears during a downtrend, symbolizing the continuation of the bearish sentiment. The second is a white or green candlestick that follows, separated by a gap, signaling a strong shift towards bullish momentum. This sudden reversal is significant because it illustrates a rapid change in investor sentiment, suggesting that buyers are entering the market with force and might push the prices higher. When navigating the pitfalls associated with the kicking bullish pattern, investors should proceed with caution. Despite the strong bullish signal this pattern represents, it is crucial to validate it with additional analysis. Market conditions are not solely governed by patterns and can be influenced by a wide range of external factors such as economic news, geopolitical events, and changes in market liquidity. To mitigate risks, investors should consider confirming the reversal with other technical indicators and market analysis tools. This approach helps in ensuring that the bullish momentum is not just a temporary market reaction, but a genuine shift in market sentiment. Additionally, setting stop-loss orders can protect investments from sudden market reversals. In summary, while the kicking bullish pattern is a powerful indicator of a potential bullish reversal, it is essential to approach it with a comprehensive analysis. Confirming the pattern with additional indicators and being mindful of broader market conditions can enhance investment decisions and reduce the risk of false signals. In the context of a strong bullish reversal pattern identified by a gap, referred to as kicking bullish, the strategic applications of this pattern are crucial for investors to understand. The kicking bullish pattern is characterized by a significant gap in the price movement of an asset, which signals a strong reversal from a bearish to a bullish trend. This pattern typically emerges after a period where the market shows signs of consolidation or decline, followed by a sudden and sharp upward movement, creating a gap on the chart. To leverage this pattern strategically, investors first need to observe a clear bearish trend that exhibits signs of losing momentum. The emergence of a gap where the price jumps significantly overnight or over a short period without trading activities in between marks the beginning of a potential bullish reversal. Investors monitor for a high opening price on the following day that maintains its momentum, confirming the shift towards a bullish market. In terms of application, once investors identify the kicking bullish pattern, it is considered a strong buy signal. Before taking action, it is essential to confirm this pattern with additional indicators such as increased trading volume, which suggests wider market recognition of the bullish trend. Incorporating this pattern into investment decisions involves setting strategic entry points just after the pattern has been confirmed, with attention to risk management strategies such as setting stop-loss orders below the gap to protect against potential market reversals. Additionally, investors might use this pattern to adjust their portfolio allocations, increasing their positions in assets showing this bullish signal. Moreover, the kicking bullish pattern can serve as a cue to explore further investment opportunities in sectors or markets that are starting to show signs of a bullish recovery, thus optimizing portfolio performance in line with market dynamics. Understanding and strategically applying the kicking bullish pattern requires keen observation, timely decision-making, and a comprehensive approach that integrates this pattern with other market analysis tools for optimum investment outcomes. Exploring variations within a strong bullish reversal pattern, known as kicking bullish, involves understanding the subtleties that make each instance of the pattern unique while retaining its fundamental characteristics. This pattern is typically marked by a gap, which is a significant space between the closing price of one session and the opening price of the next, indicating a sharp change in investor sentiment from bearish to bullish. In its most classical form, the kicking bullish pattern will show an initial bearish candlestick followed by a gap and then a strong bullish candlestick. The gap between these two sessions is pivotal, signifying a swift shift in market dynamics. However, the variations may include differences in the size of the gap, the volume of trading during the formation of the pattern, and even slight variations in the shapes and sizes of the candlesticks involved. For instance, a larger gap may indicate a stronger conviction in the change from a bearish to a bullish outlook, potentially leading to more significant upward movements in price. Conversely, a smaller gap, while still significant, may suggest a more measured optimism among investors. Moreover, the trading volume provides additional context. An increase in volume during the formation of the pattern reinforces the validity of the reversal signal. It signifies broader market participation in the bullish reversal, thereby increasing the pattern's reliability. Lastly, the exact shapes of the candlesticks can vary. While the ideal scenario involves a decisive bearish candle followed by a strong bullish candle, variations might include candles with smaller bodies or longer wicks, each adding nuances to the interpretation of the pattern. In summary, variations in the kicking bullish pattern, such as the size of the gap, trading volume, and candlestick shapes, play crucial roles in assessing the strength and reliability of the bullish reversal signal. These subtleties allow analysts to gauge market sentiment and make more informed predictions about future price movements.